Hi there, welcome back. You're watching IndianOpen right here on BloombergQuint Live. It's a mixed performance in the Asian markets, where China is doing okay for itself. That's up about a quarter. Rest of the markets, not so much. Hang Seng is down about 0.75%, while Japan trades lower by about 1.8%. SGX Nifty, while showing you a 0.5% cut. Remember, yesterday when SGX Nifty closed, it was down just 0.6% lower, while we closed down 1%. So this could actually just be a cover-up for the SGX Nifty to come back to the normal mean that we've been seeing. But obviously not to say that the environment is not weak, and we could actually see a downward bias, but may not be to that quantum. Also important to see what's been happening in the futures and options space, because it is the monthly expiry today, and Namneet joins us to give us a quick update. Namneet, good morning.
Good morning to both of you. Well, the only hope today is let's see if there is any short covering bounce or not, despite of that weak environment we've been talking about. Yesterday, you did see the rollovers at least picking up for Nifty, which stood at 61%. Remember, after a while, we breached the 200-day moving average, and not just breached, actually, Nifty closed below the 200 DMA as well. And now let's see whether there is any sort of bounce back which comes from current levels or not. Moving on to Nifty Bank, interestingly, this one outperformed Nifty, and if you were to look at the levels, the closing level was higher than the opening Nifty Bank level, which apparently technically is viewed as a positive sign. So let's see whether that outperformance continues or not. And even for the series, by the way, Nifty Bank is down just 1%, while Nifty is down about 3%. Rollovers stood at 54%, and across the series, we did see some bit of addition coming by. And Nifty Bank, by the way, is also trading above the 200-day moving average. This one bounced back after touching that mark in yesterday's session. Volatility spiked once again, and this one was just ahead of expiry today. So 18.2 is really high for the bulls in case even if there is any sort of recovery. This tells you that that recovery may get sold into. Another sign of short covering could be PCR is really low. It's fallen to levels of about 1, which basically tells you we are in an oversold territory. So let's see whether there is any bounce back or not. PCR is at levels of about 1. So in terms of distribution now, maximum open interest on the put side has moved to levels of about 11,600, while on the call side it is at the 11,800 or 900 levels. I think on the downside you should watch out for first yesterday's low of 11,640, and then your recent low after the budget of about 11,614 is something you should watch out. And goes without saying, last few days has been more about call writing. 11,700 and 800 strikes saw writing in trade, while the writers of 11,800 put ran for cover. Moving on to stocks then, individual stock futures in yesterday's trade, there were a lot of stocks which moved around. Pharma is a pack, and Glenmark specifically saw fresh long positions. Hindustan fresh shorting seen there. Motherson Sumi continues to be weak, so this one also witnessed fresh short positions. And metals as a pack has been weak off late, so JSPL was once again under pressure. Looking at the FI data, of course, the selling in the cash continues, but even on the index option side, they created a lot of short positions. This could be all expiry trade, because even if you look at the index options data, there was addition in both call long as well as put long. With that, it's back to you guys.
Right, Namneet, thanks very much for that. Remember, we've been talking about how the FI positioning has been for India, and looking at the kind of money that they have pumped in, there's still that big risk of them pulling out big money if this gets worse. I mean, in January and Feb, they've already pumped in 20,000 crores into equities. The last year was a 1 lakh crore kind of a year where they pumped in money. So there's a lot of money that's already in the system.
Yeah, and looking at the money outflow from the Asian markets as well, and India too has seen its fair share. There's no saying that this will not continue. I mean, it's just so unpredictable, Devina. How do you kind of predict what the FI community will do in the near term?
It's difficult, and considering that the sources of investment are shrinking and narrowing down. Parthiv Shah, Director at Tracom Stockbrokers, is joining us right now. Parthiv, good morning to you. Let's talk about, what is it that you advise investors to do? Sit tight, wait to ride through this period and this turbulent time, or look at this as an opportunity, and, if you do have spare cash lying around, it's not bad time to deploy.
Good morning. Even I kind of recollect our past conversation where we were finding it a little surprising that despite initially the coronavirus scare was more predominantly in the China, but I think none of the world markets were reacting. And we even discussed about the fact that with things slowing down in China and at many places and key industrial hubs kind of stopping all sort of work, I think it will have a huge supply chain disruptions. And now I think the predictions are of very tepid Chinese GDP growth of anywhere between 2 to 3%. So I think now what has happened is, and the reason why now all of a sudden we are seeing global markets and even the US markets getting spooked is the proliferation of cases in countries like South Korea, Iran, and even like now in US. The healthcare over there is talking about a sort of a pandemic. So I think no doubt historically we have seen such viruses and such flus create a scare, and we have seen the global markets correct anywhere between 5 to 10%. But if I go by the history and assuming that this particular virus is not going to be as scary as the way it is made out to be, I think this could be a fantastic opportunity for investors to cherry pick some of their favorite stocks. Because in this correction in the Indian markets, what we are witnessing, even the very, very strong names, which are maybe the domestic institutional investor favorites or the FI favorites, even they are starting to crack. And I think fundamentally there has not been any major change in them. Say if I have to talk of names like HDFC Bank, that has corrected quite heavily from its peak. So I think investors will get a lot of opportunities in this market. But to our investors, we are suggesting that if you are sitting on cash, there's not a bad idea to start deploying it right away. And if not immediately at one go, but in a staggering manner, I think that would really make sense.
All right, I think the verdict is out on whether this virus is scary or no, Parthiv. And it looks like, this could be one step closer to becoming a pandemic instead of just being limited to an epidemic. But aside from that, we've seen reactions. We've seen worse of reactions in the previous epidemics, SARS, MERS, Zika. Call it which name you want to. But I guess this move this time around at least seems to be a little bit more contained than the previous viruses. Aside from that, yesterday's session showed that the banks were pretty resilient. It was more the non-financial heavyweights that weighed down on the index itself, and the fact that autos took a big beating.
See, certainly, I think if you see like the auto markets, even I think the Automobile Association is talking of a very, very tepid volume growth this year. And there were a lot of talks or a lot of hopes in terms of as and when the transition to Bharat Stage 6 takes place, I think we'll see some sort of pent-up demand. But a lot of automakers probably are not really penciling in. And last year, what we had seen is a lot of automakers had cut down in terms of their production. And none of them is coming out with a commentary that now they're trying to improve the production. And again, in the automotive sector as well, we are of the view that there would be some sort of supply disruptions because a lot of component manufacturers are kind of sourcing from China. So still that is a risk of unknown. But nonetheless, in the automotive market, I think on any further correction, I think Maruti looks extremely good. We are going with companies like Maruti because they are the type of companies which are sitting on huge cash balances. And these are the type of companies which will be able to innovate their way out and also be able to sustain a lot of their dealerships. They might even land up supporting them at the cost of reducing their cash balance. But that is what strong companies do to sustain their businesses. And Maruti is one company, if at all on further dips of 5%, I think would be interested to start nibbling into it.
Okay, Parthiv, so many stocks in news which we want your reaction to, but let's go across to the research team to first talk about them and then get in Parthiv's view on those. So Nikki and Agam join in. Nikki will take us through the key stocks in news today, and Agam will take us through the analyst highlights from the Federal Bank analyst meet that they held. Good morning to both of you. Nikki, good morning yet again, of course, but what about the stocks in news?
I'm going to start off with the Polo Tires first, where BloombergQuint has decided to invest around $150 million in the company. The company will be issuing in 10.8 crore compulsory convertible preference shares. The investment at 100 rupees a piece. We're also looking at Thomas Cook, where a buyback announcement is coming. Do keep an eye out on this one. The company is going to be buying back 2.6 crore equity shares at a price of around 57, which indicates a premium of around 15% from the previous market price. With this, the promoter's stake is likely to increase to 70% from 65% post buyback. We're also looking at RITES, where the company, or rather the government, has proposed to sell in close to 5% equity in the counter via an OFS. The floor price for the offer has been fixed at 298 per share. And last in the list, we're looking at HUL, where there is a final NCLT approval come in for HUL and GSK merger. This is the last step, and after which this is expected to be largely positive, given that this is a large major required approval, and it removes any sort of uncertainty on when the deal will be completed. expect FY21 to be the first full year of the merged entity, and do watch out for the 30,000 crore HUL shares that GSK could offload post-today.
Okay, we'll watch out for this one. HUL could be an interesting one. There are EPS benefits out of this. We'll talk to Parthiv about it. Agam, what about the Federal Bank analyst meet?
Well, positive commentary coming in from the management. They are saying that as far as their return on average or assets expansion to around 1.25% has been reiterated for the year of FY21. The bank plans to launch credit card businesses, and of course, they're leveraging up to 10 million customer base. They're continuing to build a strong liability franchise with a focus on asset quality. Of course, the bank continues to follow a branch-light, distribution-heavy model, and they're gaining prominence, especially outside the home market. So that, of course, is also a positive. These are some of the main takeaways as far as Federal Bank is concerned on the back of what we saw in the analyst meet.
Okay, thanks both of you for giving us those perspectives. Parthiv, may I ask you, how do you view this Chandigarh NCLT order for HUL? There is a bit of a lack of clarity about what would happen to the shares that GSK offloads for HUL. Some people believe that the parent might buy it in tranches. Some people believe that, rightly so, that there is no official clarity as of now. And what if the shares come in the open market for selling? How do you view this? What would it mean for HUL?
See, I think this has been quite a long-drawn event, and this particular merger was announced very long ago. And I recollect the fact that initial approval from CCI had come, and post which I think all the bureaucratic hurdles were taking place. But nonetheless, Neeraj, I am very confident that what's going to happen eventually is that with GSK Consumer under the belt of HUL, we are extremely bullish, because I think what's going to happen is, we know the fact that HUL has a huge amount of distribution and channel network, and GSK Consumer, I think, has fantastic brands like Boost, Crocin, Eno, Horlicks, and even likes of Iodex. And I think all these brands, I think the HUL's vision is going to be to kind of scale them up in their distribution network. So I think this merger is certainly a win-win. And yes, one would argue that currently HUL is quoting at very, very expensive valuations. But I think a lot of this particular merger synergy is also into the valuations of HUL, which could be scaled up big time. But yes, the bureaucratic hurdles in terms of how it will pan out in terms of the shares coming in the open market and how does HUL end up acquiring them is still a question mark, and probably time will only tell. But nonetheless, this merger is extremely bullish for a company like HUL and its shareholders.
Okay. Let's talk about one active stock then, which has caught the fancy of big investors, and that's India Cements. Yesterday's session saw another 9% gain, to 20% gain rather yesterday. Today probably could see further gains adding up. Last 7 days, 42%. What do you think has worked for this one, Parthiv, aside from the investors?
See, Devina, if I have to look technically into this company, India Cements, I know of the fact that most of their cement capacities is quite, in terms of the technology, very obsolete, and they need to spend a lot on modernization. And that is the key reason why, if we look in terms of the performance, India Cement, whenever it reports numbers, and one of its peers, Ramco Cements, I think, which also operates a lot in the same geography, there's a huge delta in terms of the EBITDA by ton that India Cements reports vis-a-vis what Ramco Cements reports. But nonetheless, I think the valuation in terms of EV by ton multiple of $40 probably makes one feel that, this could be a great bet if at all the existing management talks about, I think, exiting the company, because what we are hearing in terms of the chatter is that there's some sort of succession problems. And if at all the management lands up selling this asset, it could be a great acquisition for a lot of players in the south. And in the south, I think there's a lot of overcapacity because of a lot of limestone mines. So I think what's going to happen is eventually there's going to be a lot of consolidation that's going to take place. And with almost 15 million tons of capacity, this could be a huge bet. And now with one very prominent family, Mr. Domani's family, owning almost 11%, a lot of investors are now finding a lot of confidence that, this could be probably a turnaround case. But we are of the opinion it's never a great strategy to follow somebody else's investment case, because for them, this is a very minuscule part of their overall wealth. So investors need to be cautious on this front. In South, we still prefer Ramco Cements as the best cement play.
You know, the thing is, Devina, I don't know if how people, I mean, what the rationale, Parthiv is right, what rationale would they have for buying? But just look at an EV per ton comparison. Ramco is, I think, $150 EV per ton. India Cements at 54 or 55 EV per ton. And whenever N. Srinivasan has come in, he's spoken about demand looking strong. Now, the point is very well taken that you shouldn't follow an investor. Well, you also got to give credit to the fact that these guys know and can smell opportunities when the mere mortals can't. And it might not be a good idea to follow them, but maybe there is some rationale about business picking up or something, which Radhakrishnan Domani has seen.
They sound like gods right now.
No, not really. I mean, well, in investing parlance, they are really a cut above the rest, right? You got to accept that. They've created wealth. Radhakrishnan Domani, for all his investments in the past, the way he's built up this fund franchise called Avenue Supermarts, they are better investors than a lot of others. And when they are doing something, you just got to pay heed to that. Yes, Parthiv's point is well taken. Don't follow them just because they have bought, because their logic and their time frames are completely different. But you got to pay credence to the move that has happened. Anyways, let's talk about the charts for a minute as well, and get in Hemen Kapadia of KR Choksi, who joins us right now on the show with his thoughts. Hemen, good having you. Thanks for joining in. How are you approaching trade today?
Very good morning to you, Neeraj. Thank you for having me. I don't have any script-specific recommendations simply because at least the SGX Nifty is seeming to show another gap down. I mean, we spoke on Monday, this US is going to tank, that's happened. I think now we're coming to those, we spoke about that, Neeraj, 11,633, 11,615. We almost coming to those levels. There was a gap which we spoke about, got covered up. So, I mean, if we open gap down, or even if we open gap down, if we break yesterday's low today, chances are that there'll be some short covering and we'll be stabilizing just a wee bit. So, if you open weak, a late recovery cannot be ruled out. The VIX has gone completely through the roof at 18.26, so it's obvious the market isn't going to sustain. Having said that, till US doesn't recover, I don't think we are going to stand alone recover. A 1 to 3 trading session bounce is on the anvil. Does that happen from today, tomorrow, day after? I am not sure. That's why I don't have any stock specific recommendations. But one, I wouldn't short anything now. Two, I would look for a high risk bounce. Like I said, today, tomorrow, day after. These 3 trading sessions, we will see a small bottom and an unsustainable bounce of Nifty 150 points or 200. And then we'll come back and test these lows of today or whatever. And then we decide whether it's going to hold or we go another 200 points down. So honestly speaking, not a very tradable market, but currently I think it's a bit overdone. And like I said, 1 to 3 days, we see a small bottom and a bounce.
Okay. So in light of the fact that the bank Nifty is outperforming the index of late, at least yesterday's session, not too much of pain in terms of the Nifty bank, do you see a better chance of having a trading opportunity here instead of the Nifty?
Well, very valid point, Devina, but frankly speaking, it's a double-edged sword. Yes, very, very valid point. Either the bank Nifty tanks to catch up with the Nifty, or it pulls the Nifty out on the morass and, we see some sort of a recovery coming in. But I think the bank Nifty, despite the very clear apparent strength, might just implode one day. And now, does the bounce come in first, or does the implosion come in first? But you're right, if the bounce comes in, it is a very clear choice to play the bank Nifty, because looking at the relative strength right now, the bank Nifty is better. So yes, if I were to anticipate, or if I see some, half an hour early chart, some crossover buys come in, some technical positives, I think the bank Nifty seems better place to play the bounce currently. Devin.
Okay. Individual stocks then, I guess there would be pockets of opportunity.
Yeah, but I wouldn't have anything currently, but I'd look for stocks which either have relative strength or they have been battered beyond submission, something like a Reliance or State Bank has relative strength, or even the metals, like Tata Steel, Vedanta have been, hammered badly. So if, once again, it's not a recommendation now, but if I see a small revival in the market on the hourly charts, I think something like a Reliance or a Tata Steel is something which I would look to play. But once again, high risk, and we would have to wait how the market plays out. And especially if it breaks yesterday's low, then I would wait just a wee bit.
Okay. The worst performer on the index yesterday was GAIL. It was down about 5%. Is there more downside open for this one? I mean, it's been on a downward trend since the last, a few months now. 1 year performance has been down 35%.
Well, frankly speaking, to be honest, absolutely right, Devina. In fact, GAIL has been down even before this whole TRA thing happened. We peaked at 200, and since then we posting lower top, lower bottoms. And I think recently, yesterday itself, we posted a 3.5-year low. So the weakness continues. I'd stay away. A bounce is going to be sold into. We've broken down from a 134, 110 range, which was formed by the last 4.5 months, and now we've broken down from this range. So any bounce, not going to sustain, and we posted a 3.5-year low. So it's going to go down more. I'd wait for a bounce if I were to short. Ideally stay away, but distinctly weak. There doesn't seem to be any major respite. I'm not saying a small respite with the market. Obviously, it would do something, but no major respite. Distinct weakness continues to look.
Okay. The other pocket then, Partha, I want to talk to you about is, the ones that have, weathered this storm of sorts, at least in the short-term time frame. I mean, you've got the likes of Asian Paints, which has managed to hold pretty steady ground. And that's a pocket because obviously the crude oil, factor plays out for it as well. It's now getting deeper into a bear market. Aside from that, a few names within the IT pack, likes of HCL Tech or Infosys and SBI for that matter.
See, Devin, I would even like to highlight a lot of chemical companies which are kind of now coming out to be true beneficiaries of whatever has happened in China. And say we talk about a company like Navin Fluorine. All of a sudden, out of nowhere, this is a company which gets a huge order. And the best part about this order is it's a long 10-year sort of an order book, wherein I think it's a surety and the amount of capex they need to do to fulfill this order, I think is not very high, which goes to show that now a lot of Indian chemical companies have created the capability and the technological advances in terms of garnering such huge orders from a lot of European and US based customers. So I think a lot of global MNC chemical companies are scouting for Indian chemical companies for such long-term orders. So that is the key reason why I think despite the markets being so volatile and being very corrective, I think what we have seen likes of Aarti Industries, which have highlighted a lot in the past, Vinati Organics, Atul Limited, all have done extremely well. And even likes of Navin Fluorine, along with now what we find very interesting is NoSil, because even NoSil as a company, you guys were discussing the tire sector via Apollo tires, but what we find comfort in is that there's not a bad idea to play such proxies like NoSil, where they are not only going to cater to the tire industry, but a lot of other rubber-based industries where their specialized chemicals, which are non-sulfur based, could play a huge part in terms of how the company does in the long term. And plus, they have expanded their capacity to almost double, quoting at 11 times. I think these are the type of opportunities which we find very comforting. And in the paint sector, we've been very bullish on Asian Paints and Verge Paints, though their volume growth could be tepid. But you very rightly pointed out, Devina, that thanks to the lower crude prices and the lower titanium dioxide prices, I think these guys are going to make really merry in terms of expanded gross margins along with very healthy EBITDA margins, which should probably sustain their current steep valuations.
Okay, watch out for some other names. Neogen, IOL Chemicals, Navin Fluorine, Alkyl Amines. A set of these chemical companies did exceptionally well in trade yesterday and are trading at 52-week highs. So, well, good going for some of those for sure. Parthiv, this deal that Navin Fluorine has struck, contract manufacturing, something that Aarti Industries has done in the past as well, and now Navin has entered into the market, has given a table-thumping reward to this one. What happens here? I mean, is this a first leg of an up move, and then would these stocks tend to benefit more? How do you approach some of these stocks which have already given a strong reaction to a move on an announcement?
Also recollect, we had discussed alkyl amines at lot lower levels, and along with Navin Fluorine, the recent order, also likes of Aarti Industries also got such very long-term contracts from a global agrochemical giant. I think what this proves is the technical capabilities that these companies have developed, and it's not about the short-term gain, because probably over the next 1 year, nothing of this is going to get percolated into the results. It's a slightly long-term structural story, but this particular trend is extremely enlightening, because probably this is just kind of a start of new things, because what could happen is if one company has given such a big long-term contract, trusting the company in terms of its technological ability. And in case of Navin Fluorine, I think we have to understand the fact that fluorine chemistry is extremely complicated. There are very few players in the world who can kind of do things what Navin Fluorine or SRF or Gujarat Fluoro does. So in which case, I think in case of Navin Fluorine, where they're focusing a lot on fluorine chemistry related to the pharmaceutical molecules, I think this could be the start of a lot many other contracts that this company could receive from many other global pharma majors. And more importantly, I think with things developing in China in terms of the labor cost going up, the supply chain disruptions, I think a lot of these global companies are looking at an alternative source, where I think in India, likes of Atul, Aarti, Naveen, I think really fit the bill with their management credibility and the way they have moved their business going ahead.
Okay. We've got about 3.5 minutes left to go for market pre-open, and since we're on the topic of some of these chemical companies and the bigger movers thereabouts, Heymain, let's talk of a possible trade here, and whether or not from a short-term perspective, after the recent run-up, there's still more steam left to go.
Yes, I think it's a very relative sort of a scenario, frankly speaking, Devina. And everything has run up, but there are some of these mid-cap stocks which haven't done well. I think something like an Himadri Chemical, it hasn't done well. It's been down for the last almost 2 years. 195, we've gone to $50, now at 55.80. It's in the throes. It's in the process of bottoming out. It hasn't yet, but like you said, some of them. I mean, some of these stocks you spoke about have run up, so I'd go for a contra trade like this, which hasn't done anything, and I'm hoping for a reversal. So maybe if you're going to buy 100 shares, buy 20 now, wait for a confirmation, add more. But so I'd look for something like this, which has been down and out and is promising to technically stabilize. And obviously, safe rides would be to go in for one which have run up, but this would have more comfort levels. The stop loss would be more affordable. Risk-reward ratio would be in your favor.
One stock that showed some decent moves in yesterday's session after, an absolutely flat move post results. I saw a spurt post results, but then came off as well. Varun Beverages yesterday was up about 3.5%. Heymain, would you buy Varun Beverages now? Are the charts suggesting that it could see a further upside?
Well, yes. Volume spike highest in the last 8 trading sessions. We are in a consolidation phase. The range is between 750 and 870. Well, frankly speaking, we would need a close above 870 for this breakout to happen. Yes, we are safely ensconced in an uptrend, higher tops, higher bottoms on the monthly chart. So, yes, if you're saying standalone, Varun Beverages does look good. Will I buy it in a market like this? A small quantity, yes. But I would prefer to wait for a breakout above 860 or 870 before going long. So, I have a clear stop loss in place. But yes, it looks good. The technical structure seems fine. The breakout hasn't happened, but it is giving all indication that it wants to give a breakout there.
Okay, that's Varun Beverages for you. Heymain is going to still wait it out a bit till you see a clear breakout above 860, 870. But the trend is clearly positive on this one. 42 seconds left to go for market pre-open. Just a quick glance across Asia. While China is holding up pretty okay for itself, you've got it up about 0.25%. Hang Seng is trading under by about 0.75%. For the SGX Nifty too, again, like we said, it could be a partial cover-up for yesterday because it shot shop and then the index here closed much lower than the SGX Nifty. But that we'll have to wait and watch as to how the pre-open shapes up. Around 14 seconds left to go. Your key movers, obviously Reliance Industries, that's the one that's raging havoc over these last few days. Whether or not that continues to see some downside pressure, we'll wait and watch. So that's what you've got in terms of the first ticks on the index. Won't go by it actually. You'll still see a lot of volatility till 9:08 till we finally see that rate on the index. But the start seems to be a bit more positive. That's because you've got that unnatural pop in Dr. Reddy's, which is up 8%. Z is up 4.5%. Bharati Infratel is up 4%. All first ticks. Reliance Industries is also up 2.5% right now. Bajaj Auto 2.5%. HDFC that's moved up. SBI that's up as well 2%. So 334 pre-open ticks. Remember, keep that at the back of your mind. HDFC Bank is up 0.5%, Yes Bank 1%, ICICI Bank 1.5%. Lot many more gainers this morning. Losers, there are a few. Cipla for 1.5% under. That's the worst performer. Reliance Industries now moves into the red. That's down 1.2%. UPL, ITC, BPCL, TCS, Britannia are some of the losers in trade today. But the flavor is clearly more bent towards the positive side, and the Nifty itself 0.25% higher. The rupee flat, about 71.64, so no major changes out there.
Shipping Corporation of India is showing a downtick of 6%. You would guess that if indeed some of these globally trade-linked stocks are going to face pressure, then maybe the markets will react. Let's wait and watch if this continues. India Cements is showing an uptick of about 10% in the first 1 minute. Let's see if that lasts. There are 2 or 3 names which are in news due to brokerage calls as well. Mindtree Cities come out with a cut on a target price. Let's see if that one reacts negatively. Well, for now, about 2.5% lower after the 2% cut yesterday. Let's wait and watch if this deepens. We'll talk about the Morgan Stanley note in just moments from now, but watch out for the gas stocks. And then, amongst others that are reacting, GSK Consumer 2.5% higher. So let's wait and watch what happens to that one. And you've got to watch out for Neogen Chemicals. That stock was up in double digits in trade yesterday, sudden surge. Let's see if there is more in store. 537, 2.5%. Varun Beverages was the best gainer on the mid-cap, BSE mid-cap index yesterday. Let's see if that is continuing. No, not quite. Just a bit of a pullback. But we'll give these rates a chance to stabilize before we talk more about them. For now, let's take it to Agam Vakil, who joins in right now with the key brokerage calls of the day. Agam, good morning. Which note is standing out?
Well, this morning we have a note on city gas distribution companies, and Morgan Stanley suggests that the recent correction can be taken up as an opportunity to buy into some of these companies. The reason here is the fact that they do see an opportunity because of volumes growth and margins, which may sustain despite the possible regulations that may change that the government may be considering right now. They see gas deflation, and there's room to grow in newer cities for a lot of these companies, especially taking on some of the other competitors. Based on that, Morgan Stanley remains overweight on Gujarat Gas with a price target of 301. Say that their area of distribution in Gujarat offers very high growth potential. They have a quasi-monopoly business model, given 70% of the business volumes come from that geography towards Gujarat Gas. As far as IGL is concerned, Morgan Stanley once again remains overweight when puts a price target of around 525. They suggest that IGL is well placed to benefit from expansion in Gurugram, Rewari and Karnal, and they have superior earnings visibility, and that's the reason why they are a tad more positive now on the city gas distribution companies.
Well, thanks so much, Agam, for giving us that perspective. Parthiv, coming on the city gas distributors, there is this whole talk of competition coming in. Now, ICICI Securities, in their note, believe that there is substantial downside to these names. Morgan Stanley comes out and says that you should use these as an opportunity to buy because there is enough room for growth. And their presumptions are about what Adani Gas and Total JV could do and a few others, etc., etc. What are your thoughts here?
What we understand is that there are certainly a lot of entry barriers to this particular business model. It's not a very easy business where anyone can just come in and just because the competition is opened up, they can just come in and set up and create that customer network that a lot of these guys have already created. And these players have been in the business for a very, very long period. So our sense is that no doubt the competition might hurt these companies slightly, if at all a very aggressive player, a player with maybe say a foreign MNC pedigree, having a lot of domain knowledge in this particular industry, were to come up and were to disrupt the industry, then it's a different fact altogether. But we feel that the current incumbents will be in a very good position because in the recent auctions also, they have won a lot of new geographies. And what is the enlightening factor is that they are already growing their volumes from the current geographies. The price and the supply of natural gas is quite stable for these players. And even in the new geographies where they are doing a lot of capex, for example, likes of IGL is talking about capex of almost 800 to 1,000 crores over the next every year over the next 3 years. I think this similar strength probably I really doubt a new player would be able to show. So I still believe that any such corrections in likes of IGL or Mahanagar Gas Limited or for that matter Adani Gas, I think makes good sense for investors to accumulate for longer horizon.
By the way, the other one which is in focus is Apollo Tyres, maybe because of the Warburg investment, but 3.5% higher at 154 for Apollo Tyres. Now the other, I mean, while trade and business may be slow, crude price downticks should also help from an immediate technical perspective, but this investment is probably being viewed by the market as a positive. I think the stock is doing whatever it is doing, or whatever it will do in the day by virtue of that note. How does it look on the charts, Hemen, Apollo Tyres, or if not Apollo, maybe some of the other tire stocks like Seat or Balkrishna?
Okay, now Balkrishna is on a completely different tangent, Neeraj. If you look at Balkrishna, we remain safely up in the sense we've been up for the last 7 months in a row, frankly speaking. So it remains, okay, short term we've just walked into a correction, but the bigger picture still remains fine. And Apollo, on the other hand, is making new lows. So, you know, it's like the North Pole and South Pole. Apollo is almost at its 4-year low. So Balkrishna looks completely different. Apollo looks completely different. MRF is mostly like Balkrishna. It's done well multiple months, and Seat is sort of now stabilizing. But Apollo 1 has been weak, oversold. I wouldn't expect too much of a downside, but in technical positions, it's like completely opposite.
Okay, Parthiv, what do you make of this investment in Apollo? And is Warburg seeing something that the market isn't, or and would you analyze this stock afresh, or are there better names to look at?
See, Neeraj, no doubt. I think a very, very credible name has parked in funds in this company. But I think our problem with Apollo Tyres has been a lot of its operations are also in European markets. And again, I think sometimes a lot of these tire companies where I think there are too many moving parts in trying to track, you know, their international business presence makes it very difficult. And probably that's a key reason why we've never seen likes of Apollo getting massively re-rated. And also their market share in the replacement tire market, which we focus a lot in terms of looking into a lot of tire companies because the replacement tire market brings in a lot better margins. Apollo is probably not the market leader. So we still feel stocks like Balkrishna Industries, or for that matter MRF, which has held really extremely well even in turmoil at a point in time when rubber prices were high. And now knowing that the rubber prices have kind of collapsed, a lot of crude derivatives have come off, these companies might not be in a great position to garner a lot of volume because of the tepid OEM segment. But even if MRF, being the market leader in the replacement tire market, could do extremely well with a lot of improvement in terms of their margins. So I think I would still prefer MRF over Apollo Tyres. And Balkrishna Industries, no doubt we like the story, but the stock has run up because it has a lot of international presence, and post-coronavirus, I think one has to be a little cautious out here.
Okay. That's Balkrishna Industries. The index, the Nifty 50, now marginally under, so down 0.1% right now, 11,663. Remember, the budget day low was about 11,633. So you know that's the next marker to defend. But again, it's the expiry day, the monthly expiry day, so you really can't tell which direction this goes. Sensex is up though about 0.1%, and Nifty Bank, in tow with what the Nifty has been doing, is down 36 points. Let's talk about a few of these pharma names. You know, Parthiv, while obviously there has been a whole lot of chatter and suddenly market conversations revolving around how some of these pharma plays are good bets to be in right now. But the US FDA overhang, you know, is you know, too strong for some of these major players, and too volatile in terms of the pricing swings that happen on the back of that. Do you feel that you know, there are better plays outside of pharma?
See, I think even amongst pharma, what we are seeing is there's a massive re-rating taking place in companies which are more of API focused. We saw likes of DVs doing extremely well and still extremely well positioned to do well because of their backward integrated capability and because of their niche API, where I think the pricing is going to go up even from here because of a lot of supply chain disruptions world over. And even likes of, we've seen other companies which are providing chemicals to a lot of these pharma API players, likes of alkylamides, which were discussed in the past. So I think not necessarily, I think it would be a great idea to play a lot of US-based pharma-centric companies, because we are seeing that they are going to have, you know, challenges. They are talking about just 2 months of inventory, and a lot of them are dependent on Chinese sourcing. So because of that uncertainty, probably a lot of investors are exiting. But I think the domestic-centric pharma companies will continue to do well, likes of Alchem, and also likes of a lot of MNC plays like Abbott, which even after being re-rated and looking a little expensive, it's more of a consumer pharma play, where I think it can easily grow at the rate of 20% over the next 3 to 5 years, launching almost 100 products every year. We are very bullish on such stories.
All right, Abbott India, that's what Parthiv likes within the pharma space. Heyman, an Aurobindo Pharma, a Glenmark Pharma, the last few days, Metropolis has been a stock which is held out pretty well. Would you be a buyer there? But it's already run up too much.
Aurobindo, not yet. Glenmark, not yet. Metropolis, yes, not too much of data, but looks great. Can I digress and talk about one more pharma stock, Devina? I think Alembic Pharma is something which looks very promising. It too has had a run up, and we're on the cusp of a correction. I think the correction already seems to have set in. But on declines, I think Alembic Pharma is on the verge of giving a longer term breakout after a 5-year consolidation. So I would pick and choose Alembic Pharma at slightly lower levels.
Okay, you're minutes away from market open. Let's tell you all that you need to know to stay ahead in trade today. First up, Hindustan Unilever gets NCLT approval for its merger of GSK products. FY21 may be the full year of the merged entity.
India Cement remains in focus as Radhakrishnan and Gopikishan Domani acquire further stake in the company on Wednesday.
Federal Bank in its analyst meet reiterates its target to expand its return on assets to 1.25% in FY21. It also plans to launch a credit card business.
Morgan Stanley says the correction in city gas stocks is an opportunity to buy. It says volumes and margins will hold despite the new regulations.
And lastly, Thomas Cook has approved a share buyback. It will buy 2.6 crore shares at 57.5 rupees per share. Promoter stake will rise to 70% from 65% post the buyback.
Well, this bit of information kept the stock active for a few days, but then in yesterday's session you saw coming off about 10.5% at 57. Parthiv, I mean they're hoping to get it back. They're valuing it at a premium to the market price. Do you feel that this is a good buyback to tender in?
I'm sorry, Devin, I didn't catch the name of this stock.
Thomas Cook.
Thomas Cook. I think it's been a disastrous run for Thomas Cook investors, despite the pedigree of the management that it brings in. I think it's been shocking, and probably I think not a bad idea for investors to tender in the buyback. No doubt, I think short to medium term, the business environment for likes of Thomas Cook is going to be even more challenging. So not that I know of whether the stock would get further derated, but again, I think total wealth destroyed. So I would stay away from it.
Stay away from that one. 1.5 minutes left to go for market opening. A quick technical top idea, Heyman, from you?
High risk Reliance, Devina.
Okay, Reliance is a Heyman's top call there. The other stock I wanted to talk to you about was Sterlite Tech. That one has been under a whole lot of pressure. Doesn't seem to be going away anytime soon. At 103, do you see it reaching 100 on the downside, Heyman?
I thought we were looking at stability and respite and a possible turnaround, but evidently that's not. It's flatter to deceive, Devina. Currently 140 and 100, and we're on the verge of breaking down. So coming back to your main question, yes, all indicators are in sell mode on the monthly. Almost sell on the weekly, sell on the daily. So despite one would have thought that a multi-year decline and an oversold situation, so if 100 breaks, I think further pain left. So yes, it looks dicey at this point in time.
Looks dicey, but Reliance is the top call. I'm guessing it's a long that Heyman is recommending for Reliance, Heyman. So do watch out for that one. But Parthiv, Heyman, take a moment to thank both of you gentlemen for joining in today and giving us your thoughts. Really appreciate your time. 10 seconds left for the markets to kick-start trade. We'll start off marginally off, not too much if the pre-open rates are to be believed, and that's pretty interesting because the Dow futures are still in the red. The question is, will we succumb to some selling during the course of the day? For now, about 0.25%, but quickly slipping as well. Or are we holding fort? Well, about 0.33% or thereabouts. Banks are actually a bit lower than the others, but yeah, around that 0.33% mark for the Nifty, the Sensex, and the Nifty Bank. Now slipping more. What about the mid caps and the small caps? They should come up on your screen as well. Well, the indices start off on a flat note. No big shakes. Let's wait and watch if these rates change. But Yep, the Sensex down about 0.45%. Let's get in individual stocks. Well, a lot of red, very little green, but not as bad on open as was yesterday. What's not doing well? Cipla continues to grind lower. There is weakness in some of the globally linked metal names, the likes of JSW Steel, which is down about 1.5% or 1%. HCL Technologies corrects a bit, about 1.25%. GAIL continues to correct, I must add, about 1% lower. I think IT is not starting off on a good note because we have JSW Steel, we have HCL Tech. We do have Wipro, we have TCS, Tech Mahindra, almost all of them are in the red in the session today. So IT is not starting off on a good note. HDFC Bank incidentally is in the red as well, about 0.73%. So that puts its pressure on the index too. What is combating that downward move? Yes Bank, State Bank of India essentially. Yes Bank is just about 1.5%, not a heavyweight, but State Bank of India up about 0.4%. HDFC marginally in the green. And Kotak Bank marginally green. That's about it. Nothing too much. Maybe it's just the lack of losers because we don't have any heavyweights correcting severely, and which is why it's just about 1/3%. But a sluggish start, you would have to say, to our markets today. What about stocks at the mid-cap end of the market, which have been doing well? Let's try and see if there is some green there. So India Cement should come up on your screen. Well, another 3.5% after 2 days of a 20% or near 20% move. 42% in the last 7 days and adds another 3% today. What about companies which are trading at fresh highs yesterday, mostly from that chemical space, and all of those start off positive today. So Neogen about 1.5%, Alcala Mines another 1.5%, and Navin Fluorine after 2 days of gains adds another 0.5%. So these stocks continue to trade higher. What are you spotting, Davina?
Well, a few names to keep a track of and what's been moving within the broader market space. We'd start off with Varun Beverages. That was yesterday's top gainer in the mid-cap 100, and today as well. It's not doing all that badly, about 1% higher. Spandana Spurti is the other one. Again, the stock was up 6% in trade yesterday. Today has moved up 1% again. So that's 1165 on the stock. Suven Life again locked up on upper circuit. Dewan Housing Finance another 5% higher. I think it's about 3% this morning. So that's doing well. Lakshmi Vilas Bank, India Bulls Ventures, ITD Cement, that's up. Godfrey Phillips moves up 1.6%. And then some of these gas stocks, Mahanagar Gas up 1.2% as well. Not doing a whole lot badly. Alembic Pharma, that's up 1%. Glenmark Pharma, Apollo Tyres, Kansai Nerolac are some of the other bigger gainers in trade. Quantum of gains not all that heavy, but it's almost an even keel. Marginal divergence in terms of the advanced decline as well. Amongst losers, First Source Solutions is down 5.5%. Mahindra CIE is down 5%. Shilpa Medicare is down 5%. A lot more losses in the broader market space. So Den Networks is down about 2.5%. Motherson Sumi, HDIL, Avanti Feeds continues to lose out. Shipping Corporation and Ashok Leyland are some of your top losers in the session. 460 plus stocks advanced, 660 plus stocks declined. So there's, I guess, a 200 stock divergence out there. But it's not all that bad in terms of the market.
Well, let's get in. A voice which I'm presuming their portfolio is still doing well because they are so bent on quality, and quality still continue to do well. Pramod Gubbi, founder at Marcellus Investment Managers, joins us on the show. Pramod, good having you. Thanks for joining in. How difficult is it proving right now to predict or forecast what earnings growth would be, even for your coverage universe, considering all the going-ons around the world?
Well, I don't think, whatever we've seen, there isn't much evidence that it'll affect fundamentals. Of course, in certain parts of the supply chain, there could be some disruptions. But that, again, based on historical instances similar to this, it seems like, at best, they're going to be transient in nature. So there haven't been any evidences of structural impact. Of course, this can be different. We all, none of us are experts in terms of figuring out how this will pan out. But I think at this stage, it's too early to, make significant changes to your forecasts, or at least understanding how the world is going to pan out, and hence how businesses are going to pan out. Of course, for short-term traders, it is a matter of risk off. You would expect money to be taken off the table. But for longer-term investors with a relatively longer-term horizon, where the assumption is that the fundamentals are unlikely to change, this might actually be a good time to, take some positions.
But, okay, just wondering, one, were you saying this for market-wide or only for your portfolio? And part two, would there be a risk to multiples? Because thus far, it's not just earnings, but the market's giving a higher multiple to good set of earnings as well. But if the risk premium across comes off because of the growth getting impacted, maybe not in India but outside India, and thereby the risk premium coming out here as well, then would the multiples be in danger of getting a bit derated?
Yeah, absolutely. In the shorter term, I don't think that's a question, because as money pulls out, because multiples are driven by liquidity and sentiment in the short term, and that would apply across the board. But naturally, again, the ones with earning stability would find some sort of a cushion in terms of downside protection. Whether that earning stability itself is questioned is where I'm disagreeing, and I don't think we have seen enough to believe that. Whether it's a good company or otherwise, we don't see much fundamental impact yet, or sustainable fundamental impacts. Maybe a couple of quarters because of supply dependency on China, you might see things getting affected. But beyond 3-4 quarters, that's assuming that by summer the virus dies, and what we've seen in the past. Provided that this is not something that's new that we don't understand, I don't think there's a reason to panic.
Yeah, even when we're talking about a delay from Q4, I mean, while most companies that we've spoken to have said that they've got their supplies in order till probably April. But even if they want to, refurbish their supplies, they need the manufacturers to start production. They need everything to come back on track with the capacities and utilizations are they picking up by at least the next 1 month, so that they can be fulfilled in due course of time, which doesn't look likely. Yeah. So in light of that, can the incremental damage be more? Because now we're just hearing about till end of Q4. Yeah. Then we'll start getting comments of how it's been a little bit of a further pushback in terms of getting supplies.
No, absolutely. I don't think, we're already factoring in some sort of supply disruptions. You can't avoid that. We had a quarter lag because of the inventories that companies were sitting on. But even if things were to normalize, the scare sort of dies down, there will be a lag before capacities come back full steam, right? So I think you do need to factor in a couple of quarters of disruption. But the point I'm trying to get at is this doesn't change anything structurally. In some instances, because of pent-up demand, you might see a much sharper recovery once the supply comes back in. Some of the demand might be lost for forever, but that's okay, because you're looking at a longer term where the impact could not be significant enough for you to make a difference in terms of your position in that stock.
But the fact that we were trading at record highs, and at those levels, I think most of the people would have been at least 95% deployed, right. 95, 98% deployed. So that much less cash is there to actually optimize and capitalize on this correction. So in light of that, you have to be really picky on what you start investing in right now. So what would you do then, and how would you allocate?
Well, sometimes the best thing to do is do nothing, right? So it's this intervention bias which forces us to make decisions. And as we all know, the more decisions we make, the probability of making mistakes is higher. So better not to do much, as long as the assumption is that my fundamental thesis hasn't changed. If you are the lucky few where you have cash coming in that can be deployed, make use of the lower prices to reflect that fundamentals remain the same, but the prices are lower, so I should be deploying. But if you're fully invested, I think just not do anything is the best situation.
But not take money off the table. So I know you guys don't invest in global cyclicals, for example, or I'm guessing you don't. But let's say somebody has those investments and those investments have shaved off because of the uncertainty. Would it be prudent, would it be a prudent fundamental call to take those chips off the table simply because the future is unpredictable right now?
Well, again, like I said, unless and until you believe that you believe that the fundamentals have changed for good.
Do you think fundamentals have changed for those games?
I don't think so. Like I said, in a couple of quarters, maybe you will take a beating, because as China's demand gets reflected in global cyclicals, you will see a slowdown in those names. But is it structural? It depends on how this whole thing pans out. Based on what we've seen in history, the base case assumption is that it's transient. Could be a couple of quarters, could be slightly longer than that, but nothing to suggest that a longer term impact on industries and companies just yet.
Okay. There is I mean, just trying to figure out. So let's work with an assumption that the markets stay around these levels or maybe give better entry points as well. You guys have a set of stocks where you are invested already. They largely form a part of the consumption financials related to consumption basket, etc. When new money is coming in, are you looking at newer avenues or are you looking to deploy more in some of those?
Well, I mean, we tend to maintain the same portfolio for all clients. As new money comes in, we tend to deploy it in the same set of stocks. The philosophy is that if we believe that it's not good for buying for a client who's coming in today, it's not worth holding for a client who's already holding.
No, sorry, I didn't mean that. Sorry. Let me rephrase my question. But for all your clients, are you looking at newer sectors or themes that have come out, or are you still sticking to the ones that you have in your portfolio?
Well, by and large, the changes in our portfolio are very few and far between, right? So it's a pretty low churn portfolio. We're always on the lookout for new ideas. There are stocks in the pipeline that our research team is working on. As in when we build conviction, we will bring it into the portfolio, but nothing to reflect the external conditions just yet. We're happy holding on, and partly because we don't believe in timing the market, nor do we believe that we have skills to time the market. So we're happy to buy those where we think that fundamentals are going to hold up for the long run and continue buying them. Any
niche businesses that you've identified of late? I mean, you guys have spoken a whole lot about likes of Relaxo and the others. DV's Lab was a stock that Saurabh spoke about in the pharma space.
Right.
Any other businesses that maybe you haven't got you've got a full coverage on yet, but it's something that you've started to work on and you feel there's potential there, where much more research is required?
Well, as you might know, we've just recently launched a small cap portfolio as well, so which is full of niche businesses, because we tend to look for dominant players even in this portfolio. And if you're a dominant player in a very niche industry, you tend to be small cap. So in fact, most of our companies in the small cap portfolio are in such niche sectors. It could be an auto ancillary supplying a certain component to a Maruti or a Hyundai or a Toyota. But it's one of two suppliers to the entire industry. It could have a 60-70% market share in that. Or it could be an equipment manufacturer for chemicals or a pharmaceutical industry where the equipment itself doesn't become a large part of the capex, but it's critical enough where this company is one of two players supplying that equipment. So there are niche businesses which even during the last 2-3 years downturn have continued to deliver earnings growth. They have a very dominant competitive position in their respective industry with very little competitive threats coming through. So, and we would like to look to identify more such and build our small caps portfolio.
Okay. I'm wondering, Pramod, there are, in the last 2 quarters, we've on this forum itself spoken to a few mid-sized NBFCs who do not have balance sheet issues or ALM issues. They are small in nature, but they are looking to grow AUM by 15-20% over the course of the next 5-10 years. They're taking prudent steps as well, not going out and lending meaningfully when the tide is slightly tough right now. Would you continue to stick to large caps, or would you believe that there is opportunity even at the broader end of the spectrum in the financial space?
Yeah, there is. I wouldn't rule it out completely. Yes, there is a theme of consolidation happening in every industry where financials, particularly lenders with better access to liabilities, whether it's CASA or they've built a very strong brand in the wholesale market, they'll continue to take market share. But having said that, I think in certain niche asset classes, which have specialist skill sets, either in terms of appraising the risk of borrowers in that category, or because its collateral is very niche, there are some niche players who have remained disciplined even through the go years of NBFC when liquidity was flush. They didn't lose their lending discipline. They maintained pretty strong asset quality, and they are well capitalized. So I do think there is an opportunity for those businesses to continue to exist until such time that the category becomes large enough for a larger lender like a bank or something to enter that and then question their competitiveness, because naturally the bank with access to CASA would come up with better cost of funding. Perhaps if they can build skills to appraise risk in that specific sector, either because of the collateral or the geographical segment or the market segment, then they can become a competitive threat. But I do think that there are still areas where certain NBFCs have maintained a niche hold on that, even away from the banks.
Okay. One pocket, and again, this stems from the conversations that we had with a bunch of companies. You mentioned about how external environment impacting businesses, etc., and some of these businesses get impacted only in the short term. There is, at the other end of the spectrum, a set of businesses which are actually getting, or at least the managements are saying they might get impacted positively. Chemicals, for example,
right.
When they are saying that the end product of the import substitutes might actually go up, and it might benefit them because they don't depend on China in a meaningful way, any which ways.
Yes.
Is that a pocket? Because it's really caught the imagination of the markets right now. While the market is doing what it is doing, a bunch of these names are actually hitting fresh highs almost every single day.
Yes, we do think that there'll be a few beneficiaries on that count as well. We've already seen a move away from China over the last 2-3 years, particularly in areas where pollution norms and emission controls by the Chinese government have been stricter. But I think there's the added driver now, especially if you're a global pharma or a global agri-chem manufacturer dependent on a certain input from China. You would want to look to building a second source, and India clearly has built some credentials in that sector to come up as a credible second source. So on the back of this disruption, there could be a structural benefit for some of these pockets, particularly some of the companies which have well-established credentials against the global pharma and global chemical companies. And these, I guess the market is trying to reflect that.
Yeah. Well, let's see. I think some equipment manufacturers have also spoken about how the market for pharma might open. There's a company that we were speaking to which said that they supply to pharma companies, and they said that things might start looking better sooner rather than later. My final question, Pramod, and that's with regards to large cap financials. You always said that the heavyweights in your portfolios will stand the test of time and therefore will do well through the speed bumps as well. Are you at all considering tactically some of the smaller sized banks? We spoke about NBFCs, we spoke about large banks. What about the mid-sized banks? Will they keep on losing the battle to the larger peers, or can they make the mark?
Well, at this stage, we haven't seen too many. There's one small bank in our small cap portfolio. But other than that, in the consistent compounders, we're happy to stick to the top private sector banks. Because we reckon that the advantage they have on the liability side is going to strengthen. I think there was data for the last 6 months. We've shown that private sector banks have raised as much deposits as public sector banks. When the install base is almost double for public sector banks, so the flow is almost becoming even. So that's a big sign in terms of the strengthening liability franchise of the private sector banks, which can give them increased competitiveness on the lending rate, and they don't have to take undue risks in terms of asset quality to maintain those sort of margins. So the evidence is there. There's no reason for us to shy away. The market opportunity is huge. At some stage, the credit growth in the system will pick up. Even if these guys don't grow significantly larger than the credit growth in the system, there is a long growth runway for them. And that liability franchise is, I can't emphasize more in terms of that being the biggest strength for a lender.
All right. We leave it at that, Pramod. Thank you very much for joining us this morning.
You're welcome.
All right, the markets are worse in a slightly steep spot right now as we're looking to breach 11,600 on the downside. So 72 points given up, down about 0.6%, with the Nifty Bank this time around being the culprit. That's down almost 1%. 30,000, and could see a breach of that as well in today's session if this continues to worsen. Coming up, we take a health check of the pharma industries with Keval Honda, former managing director of Pfizer, and discuss the business outlook with Shrivar K. Ruka of Borosil Glassworks.